Hello, Happy New Year. Welcome to the first weekly market view of 2013. So it's good to have you back, Bill. Happy New Year to you.
Happy New Year to you.
And so far, so good for the FTSE.
Yes.
It's got off to an incredibly good start. I think obviously the fiscal cliff deal in the US, obviously, and a bit of optimism in general about the overall global picture. Can we see this FTSE rally continuing?
I think so. I think we may have I don't know what to say, flat line, because I mean there's still the concern of what will happen come the 28th, 29th of February, 1st of March, but we are getting a new Secretary of the Treasury designate this afternoon. But you know, I finished the year feeling that, I guess at the end of 2011, I think for the first time in years, more than 50% of assets for pension funds, insurance companies were in the bond market. Safe haven, but I think now they'll be going out of bonds, and I could easily see the FTSE getting towards 67, 6,800 by the year end.
Oh right, okay, that's a big call.
Yeah,
so
I'm very positive on the FTSE.
Over 10%. So you're seeing rotation out of bonds.
Yes, yes.
Very interesting. And so this week, it's interesting how obviously the FTSE is so detached from the wider economy. Of course, retailers. Pretty mixed bag, but overall I would have said pretty gloomy. I mean, Jessop's gone now.
I think it is, but I think maybe what you may start seeing is a rotation. One of the things you are seeing is bottom fishing. Two classic examples. One firm called Sentiment, okay, which is an oil company with Egypt. I mean, 18 months ago it was like 120. Then 3 months ago it was down to 25 because the Egyptian government was going to foreclose on it. And a classic one is a company called African Barrick Gold. I mean, it dropped, what, 91p 2 days ago because there'd been speculation on the simple fact is there was interest in from China. China pulled back. What you saw there was it sold off 91p 2 days ago. Yesterday it got a third of it back. So you're starting to see some bottom fishing. The company itself, valuable company, fundamentals haven't changed, and people sort of buying gold because there are a number of clients out there, and we're in that group, 1750, 1800, I think we can see towards the latter half of this year.
Yeah, okay, that's as I say, a good call. So the other highlights of this week, obviously today, that risk-on rally seems to be continuing. In particular, the Euro's had a good move higher today following Draghi. Let's just focus maybe on the Bank of England first. Nothing there, no QE. When do you expect them maybe to do more QE?
Well, I'm looking at yesterday's trade data, which was really disastrous, okay? And I know it goes along with my feeling that worst case scenario, we're going to flatline, you know? And I think one of the things, two things we have to look at. January 23rd is when we get the minutes from today's meeting. Was there any other person besides our good friend who's on the dovish side? But the key is going to be the 25th, because the 25th is when we get the first guesstimate of fourth quarter GDP. I'm thinking it's going to be positive, but only like 1 or 0.2, nothing dramatic here. I don't think we're going to go into a triple-digit recession. But if we see any stability or slight decline in inflation, I still feel we'll get another round of quantitative easing.
Yeah, okay. I mean, it sounds like you're relatively optimistic in terms of the UK economy, so let's wait for that number for the fourth quarter.
Yes.
So quite a few people are saying, you know, we're heading for triple dip, but we'll see at the end of this month. And that brings us neatly on to ECB. So what are we expecting there? Well, you know, going forward, because you have been a bit of a caller for a rate cut.
Still are.
Still are. But obviously missed in the end of last year,
yes.
Not cut this month. When do you think that?
I was expecting what happened today to have happened, you know, with no change. One thing I was so much surprised about with as Draghi told us today, the decision was unanimous. Now, one of the things that the ECB has got to be concerned about, this euro, 132, 133, 134, you know, if we can remember our good friend Jean-Claude Trichet, you know, years ago was talking about this line in the sand, and it's got to reach a point. We get to 132, 133. This has got to have a major impact on the exporting economies, especially Germany and France. Now, I am still expecting one more rate cut. And if you look farther out, if you look at the Euribor, Ionian spreads, I mean, there is still about almost a 40% probability that we can have 2 rate cuts late second quarter, early third quarter. My feeling is, I don't feel that way, but any continued slowing growth, we saw unemployment now at a record high, and if we start seeing any stabilization, and as Greggy said today, inflation was broadly balanced. Now, I don't know what that means, but if we see any stability in inflation and sluggish growth, consumer confidence, I could see at least one rate cut.
Okay, well that's very interesting. So it sounds like you're sort of tentatively optimistic for
Yes.
2030.
Yes.
Wonderful. Excellent. Thanks, Bill. Good to see you. That's it for this week.